in the public and the private sectors. The capital market is, therefore, fundamental to the country's economic success and plays a key role in the life of all citizens. To ensure that the supervision and development of capital market is effective, reliable, and accessible to every sector. The Securities and Exchange Commission, or the SEC, was established on 16 May 1992 by virtue of the Securities and Exchange Act 2535BE, or 1992. The SEC has a key role in supervising all of those concerned in their relationship with the capital market. For businesses that raise capital by offering securities for sale to the public, the SEC will ensure a complete information disclosure to bring confidence for the investors' decision-making. The SEC grants licenses and supervise professionals who have the duty to assist and prepare the business of issuing securities for sale. In overseeing the stock exchange, the SEC ensures that the system for trading, payments, and delivery of securities are effective, and the securities or payments are delivered properly to the investors. The SEC also supervises the stock exchange and monitors irregularities in trading, which would lead to investors being taken advantage of, and to refer any suspicious matter to the SEC for investigation and discipline where it is appropriate. In granting securities business license, the SEC oversees the licensing process and the performance of personnel such as investment advisors or fund managers, and ensures that they provide proper service and advice and protects the investors' assets. Furthermore, one of the SEC's main roles is to develop the Thai capital market and to support the creation of financial and investment innovation, such as derivatives, trusts, and digital assets, and to serve as a center for investment knowledge for the general public. By placing an emphasis on investor protection, the SEC not only accepts complaints relating to the capital market, but also gives information and advice to the public. We are SEC Help Center at 1207, 24 hours a day, every day. At the same time, the SEC has been in close cooperation with international regulators and organizations to keep driving the Thai capital market towards sustainability on par with international standards.
Good morning and good afternoon. International guests who is now together with us in the second day of the first SEC Thailand International Digital Asset Webinar, which is under the theme Policy Implication for Digital Asset Regulation, a peek at global movements. Yesterday, from an exclusive interview with U.S. Commissioner Hester Peirce, I think that all of us have learned really a lot from the practice in the U.S. as well as the Commissioner's view. And today we have an equally interesting session together, two of that, which is the keynote speech, the policy choices for regulating digital asset industry, which will be conducted by Professor Douglas Arner, who is the Kerry Holdings Professor in Law, the University of Hong Kong. And afterwards, we will have the panel discussion in the topic opportunities, challenges, and barriers of digital asset businesses, where we will have 5 gentlemen from 5 different markets talking about the development of the digital assets in their respective markets, ranging from the UK, Switzerland, European Union, Singapore, as well as South Korea as well. Well, and today, before we start with the 2 sessions, I would like to invite the Secretary General of the Security and Exchange Commission of Thailand, Khun Runwadi Suwanmongkol, to give an introductory remarks.
Good afternoon and สวัสดีค่ะ It is my great pleasure to welcome you back to the second day of the first SEC Thailand International Digital Asset Webinar. I would like to express my sincere appreciation to all who made the yesterday event become successful. Last night, Commissioner Peirce from the US SEC has shared her insightful thoughts on the US regulatory approach toward digital assets, as well as a number of interesting issues in connection with digital assets, including DeFi and crypto retail funds. I am very certain that 1 hour with Commissioner Hester Peirce last night had made you all well aware and better understand about the current development, challenges, and what we need to think ahead. For those who missed the live broadcast yesterday, you may visit our Facebook page for the record of the event. Today, we will have a great opportunity to hear from academic point of view and also from players in the industry from different regions. Together, we hope to explore interests of every party and find a proper balance between nurturing innovation while mitigating risks of participants in the market. Regardless how technology and capital market will change or evolve, SEC Thailand will continuously work on providing financial literacy and ensuring investor protection, market integrity, and financial stability. We acknowledge that getting the balance right between regulation and innovation or openness is challenging, but it is absolutely vital. We will continue to closely engage and work with all stakeholders in the market to ensure that we are building a friendly and robust environment where businesses are able to innovate and grow sustainably. Without further ado, on behalf of SEC Thailand, I would like to say thank you to our keynote speaker, Professor Douglas Arner, and our panelists, Mr. Chia Hock Lai, the co-chairman of the Blockchain Association Singapore, Mr. Ian Taylor, Executive Director of the Crypto UK, Mr. Heng Buk Lee, Head of Digital Asset Investor Protection Center, Upbit, South Korea, Dr. Manuel Meyer, and Mr. Christopher Meurer from Baker McKenzie, Zurich. I wish all of you have productive outcomes from today's discussion. Thank you.
Well, that was the introductory remarks by the host, who is the Secretary General of the SEC in Thailand, Khun Runwadi Suwanmongkol. Well, and I would like to invite all of us to witness the first session for this afternoon, which is the keynote address under the topic Policy Choices for Regulating Digital Asset Industry. Before I move further, before I pass on the stage to the keynote speaker for this afternoon, I would like to remind all of you that after the sessions, which is approximately 30 minutes, The next 15 minutes will be kept for the questions from the floor, and therefore I would like to urge all of you, should you have questions, just write it down and then drop into the chat box. As a keynote speaker for this afternoon, Professor Douglas Arner will be able to address it later on after his 30-minute presentation. And now I would like to bring all of us to witness the keynote address from Professor Douglas Arner, who is a Kerry Holdings Professor in Law, the University of Hong Kong. Professor Arner, and now the stage is yours.
Thank you very much, and thanks in particular to Kunrun Vadi and the Thai SEC for the invitation to be here today. I think this topic of digital assets is one that is particularly right now posing very interesting opportunities and challenges. And I'm going to bring up a slide presentation which will be shared to anyone who would like a copy a little bit later. And when we look at this topic of regulating the digital asset industry, policy strategies, I'm going to base this on a series of work from my team looking at various assets, various aspects of digital assets over the past decade or so. And I think if we look back at finance over the past decade, we can say that three issues have very much dominated, and that these have had an important impact from the standpoint of digital assets, of digital finance generally, and our approaches to financial regulation. And certainly the first of those was the 2008 global financial crisis. And I think coming out of the 2008 global financial crisis, from the standpoint of technology, we can see a number of major impacts. The first is that if we think about the global financial crisis, one aspect was to bring in large volumes of new regulations to address many of the issues that we identified. But there was also an important mindset change. And prior to the 2008 global financial crisis, there was generally a very strongly favorable attitude towards financial innovation of any form. And I think that the 2008 financial crisis made regulators all over the world somewhat more cautious about financial innovation. And that we can also see in the past decade in particular, the impact of technology. And I'll come back to these ideas of technology. And in particular, the past decade, when we think about technology, has been a period of applying new technologies, including distributed ledger technology and blockchain, to finance and a range of other aspects of our lives. I think if we look forward into the next decade, and I think this is very important as we come to a world not necessarily after COVID, but perhaps beyond COVID, that we are focusing on sustainability, that we're thinking about technology, but we're thinking about technology in a very different way. Technology today is much more pervasive, much more transformative than what we would have seen 10 years ago. And this provides both opportunities as well as challenges. And of course, an ongoing tension between globalization, pre-2008, but also fragmentation. And it's something that I think all of us are seeing at a geopolitical stage, but increasingly also on the economic and financial side. And into this wider context, we need to think about digital assets. And so when we think about digital assets, it's important to realize that when we think about finance and technology have been co-developmental for 10,000 years of settled human history. You know, if we look at human civilization, amongst the first aspects that we see emerging are systems of writing, systems of record keeping, particularly around tax payments or future agricultural product prices, forwards and futures. We can also think about things like coinage, metallurgy, stamping, evolving into paper money in China, eventually into bills of exchange, to checks, and over the past 150 years, we can think about the role of the telegraph in payments. We can think about the evolution of real-time gross settlement systems from the 1980s. We can think about the evolution of mobile payments from the middle of the last decade. We can, of course, think about cryptocurrencies. We can think about fast payment systems, stable coins, and central bank digital currencies. And of course, that is 10,000 years of technology and financial evolution. But I think when we're thinking about digital assets, of course, we're thinking back to just 2008 with the advent of the Bitcoin white paper, the launch of Bitcoin, both as the first cryptocurrency, but also as the first major blockchain application in 2009. But we also have to see a couple of other major technological events around the same time. Apple unveils the iPhone in 2007. And of course, the smartphone, particularly across Asia Pacific and the developed world, has become absolutely ubiquitous, giving people all across the world the power of a supercomputer in their pocket. And this means that each of us has the technology to engage with finance, technology, digital assets in a far more direct and personal way than we've ever seen before. The second, of course, is the launch of M-Pesa in 2007. And this brings together that idea of communications with technology and, of course, bringing it together with finance. You know, over the past decade, it's been a period of, I think, lots of new entrants. We can think about cryptocurrencies, we can think about fintech startups, we can think about lots of discussions across the last decade of new technologies, new participants disrupting traditional financial services and its regulation. And in some ways, it is that decade of new technological application, new entrants, which have set us up for some of the opportunities and challenges that we're seeing today. And I think we can mark this as what we call the period of FinTech 4.0. And it's really about two different aspects. One is centralization. In other words, over the past, if you think about prior to 2008, we were often dealing with questions around economies of scope, economies of scale in financial services, the evolution of too big to fail, too connected to fail, too big to save. And of course, we've also seen over the past 20 years in parallel, the evolution of digital platforms, the evolution of massive technology and internet companies, particularly emanating from the US and China, that have come to dominate markets. And when one combines these two ideas, network effects in data and technology with economies of scope and scale in financial services, one gets entirely new strata of concentration. And we've seen this very clearly in the context of Ant Financial in China and the Chinese efforts to try to balance the benefits of aggregation of data, of network effects, with some of the risks of concentration and dominance. We can also see it in what is, from the standpoint of monetary history, a seminal event, and that is the announcement by Facebook of its intention to create Libra, a private cryptocurrency which would be available across Facebook and other digital platforms to billions of people. And I think that very much highlights this idea of bringing together economies of scope and scale in finance with network effects in technology. At the same time, however, over the past 10 years, we have seen an increasing evolution of different forms of decentralized technologies and their applications in finance and a range of other aspects. And I think there's a real question about whether this decade of the 2020s will be dominated by the concentrations, the platforms, or by decentralization. And I think the way in which we approach these aspects from a regulatory and policy side is going to be central to the way that our financial systems, our societies, our economies look in a decade's time. And I think two things really bring this out. The first is the challenge from a regulatory side of new participants, and that is both startups, big tech companies, as well as independent tech platforms. The idea of different types of participants and how do you address these. And the second is really around speed. And it's something that I think over the past 2 years, we've seen scaling in an entirely different way. And as we turn to digital finance, as we turn to digital finance platforms, as we turn to digital assets, one of the challenges is that scale, and particularly the ubiquity of smartphones and electronic communications means that now billions of people are interconnected with one another all over the world. And this means that things can move from how we characterize as too small to care, to too large to ignore, to systemically important, too big to fail, in record time. And this, of course, is a major challenge for regulators. And if we think about the impact of COVID has reinforced all of these trends. It has reinforced digitization really of everything, but in particular of communication, of payments, and of finance. And I think that if we think of this from the standpoint of regulatory developments, the biggest have been in the context of digital payments, which have been essential to life with lockdowns, as well as resilience and response to COVID. We've seen this in the response of the creation of an increasing range of jurisdictions of their own digital currencies, central bank digital currencies, the use of technology by regulators and supervisors, the application of technology to market integrity and AML, particularly digital identity frameworks, and of course, these aspects of big data and technology. And when we think about digital assets, I think it's important to think about these from a number of different angles. It's not, if you will, a sort of unified group. And in many ways, one can think about different uses, different transaction structures, and a functional difference from the standpoint of regulatory policies and strategies. And I think if we are thinking about what we are seeing with digital money and payment today, we have to realize that over the past 2 decades, there has been very much a technological revolution in money and payment, both from the decentralized side, but also from the centralized side. And some of the things that we are seeing today are increasingly the combination of different aspects. So for instance, if we think about central bank digital currencies, a central bank digital currency is often bringing together ideas or experiences from the cryptocurrency area, particularly stablecoins, but applying, in most cases, centralized technology structures, at the least permissioned ledger structures under the control usually of a central bank or a small consortium. And the end result is that when we are looking at the role of technology in money and payment, I think it's very important not to try to separate entirely decentralized and centralized, because the reality is that increasingly they are interacting. And I think perhaps the piece that has driven this forward to the greatest extent is that combination of the impact of the Libra announcement combined with COVID-19. and this idea of global stablecoins combined with the necessity of digital payments and considerations around the roles of central bank digital currencies. Now, when we think about the evolution of digital assets from over the past 13 years or so, I think we can look at this from a number of different angles. And this is important as we come to some of the regulatory considerations. If we look at the early years, this sort of 2008 to 2013 period, we see the advent of blockchain, a small number of other cryptocurrencies, and generally a relatively small group of participants or users. Enthusiasts, and you can think about crypto anarchists, blockchain technologists, you can think about early gaming participants, all driving the market at an early stage. But of course, you also see in some of the initial aspects of the dark web and others, an engagement by criminals and other elements who the technology became quite appealing for. And in some ways, it is this early stage that continues to color many views. If we look at a second period, we can see 2013 to 2016, the advent of Ethereum, first major stablecoin, Tether. We can see the Mt. Gox exchange and its collapse. And I think what this period highlights is something that we continue to see up to the present day, which is broadening of users and markets. Initially, quite a small, narrow group, but we see across the period broadening more and more, and this raises both opportunities as well as challenges. We also see in this period central banks becoming concerned from the standpoint of potential challenges, cryptocurrencies challenging sovereign fiat currencies. But if we're honest, outside of a small range of jurisdictions, typically jurisdictions that have relatively unstable monetary systems or in effect payment systems, that cryptocurrencies have not generally emerged as major alternatives to sovereign fiat currencies. Certainly not in the context of major economies, most developed economies, and most of the emerging markets. At the same time, we see central banks in this period beginning to experiment with the technologies themselves. Certainly in the context of China, this is the period in which we see the beginning of the central bank digital currency projects. At this stage, early focus outside of questions about potential monetary challenges largely focus around market integrity and the potential use of the instruments by criminals, as well as from a standpoint of money laundering. We also get some early investor protection concerns, which begin to evolve. Now, 2016, 2018, we see a major broadening of the market in the context of the ICO. But honestly, even though we see a major broadening in terms of participation in this ICO bubble, it's still a relatively small group involved globally. During this period, it's still a challenge to actually get access to many of the products being offered. And as a result, from a regulatory standpoint, we can think about the FSB or IOSCO looking at regulatory considerations and determining that at this stage, in addition to those market integrity concerns, we're beginning to see concerns about customer protection, but also around investor protection, particularly if we look at many ICOs taking the characteristics of a range of investment projects. At the same time, we don't really see concerns about systemic risk or financial stability because the group of participants is still somewhat small. That really has changed over the past 3 years, starting from 2019 and going up to the present, and certainly into next year. Certainly, I think the announcement of Libra highlighted how there could be very much in the context of digital assets, albeit in the Libra case, a centralized permission system rather than a decentralized system, how there was very real potential for systemic risk, or even from the standpoint of currency substitution. And as a result, we see a major effort in the context of building regulatory frameworks to address stable concerns. And I'll come back to that. We also see the advent or the rollout of central bank digital currencies, initially to respond to some of those threats. But then, as we see the necessity and ubiquity of digital finance in the context of COVID, thinking about how we can underpin systems going forward, even to the extent of the G20 FSB payments roadmap, adopting this idea of technology to rebuild cross-border payment systems. And of course, the advent of DeFi. And I was very much predicting at the beginning of this year that 2021 would mark, from a regulatory standpoint, the normalization of digital assets. And what I meant by that was the building of international and domestic frameworks from a regulatory standpoint. We could see this with the FATF, G20 in particular, developing a framework to address market integrity and AML concerns. We could see this from the framework of IOSCO, developing frameworks for regulation of exchanges or asset management. We could see this in the context of the EU with the digital finance strategy, as well as with the proposed markets in crypto assets regulation. Proposals across a range of jurisdictions to essentially build regulatory frameworks to bring digital assets fully inside the regulatory system. And this is ironic in some ways if one looks back to the original genesis of Bitcoin. But from the standpoint of the wider development of the market, it is probably essential to bring digital assets into the normal regulatory framework to protect against our traditional financial concerns. And I think from a regulatory standpoint, the starting point is really to think about our regulatory objectives and to look at where we are today. You know, from the standpoint of market integrity, this is one where, we've had the series of efforts via the G20 and the FATF from the standpoint of building an international framework, including new amendments to that just out in the past week. But we can also see, and particularly reflected in the various G20 and BIS competitions, we can see the development or the application of mechanisms to use blockchain technology to better track use and participation. And what I think the increasing realization of particularly the law enforcement community globally is that blockchain technology, in the context of its core attributes of permanency, transparency, and security, is actually a very effective tool for tracking users. And we're seeing an increasing range of efforts and technologies applied to this. Probably coming out of COVID, the most important of these is really around building digital identity frameworks. We're seeing this in an increasing range of individual jurisdictions for individuals, and also increasing effort from the entity standpoint. So one can say that market integrity continues to be a focus, but the level of progress, the level of comfort from both the technological side as well as the infrastructure building and the regulatory evolution has come a long way. From the standpoint of consumer, depositor, investor protection, I think this is one where we are moving into a new position where the scale of projects of use are moving us to the point where widespread use adoption may in fact take us beyond simple consumer or investor protection concerns to actual financial stability concerns. And this is something that I think we see regulators all over the world grappling with. And the key here, as I'll highlight a bit later, is differentiating different types of use cases from a functional approach from a regulatory standpoint and building frameworks that are appropriate to each of these different types. I think if we think about efficiency and growth, inclusion, development, and sustainability, this is where we're seeing some of the most interesting work. And increasingly, it's not just about regulation. And where this particularly comes in is in the context of things like custody or exchanges to actually support the functioning of the market. But actually, jurisdictions like China are bringing in central bank digital currencies to give a sovereign monetary instrument which can be embedded into blockchain systems, which are then meant to enable further blockchain development without having to consider non-sovereign based assets. Likewise, from a standpoint of efficiency, many of the blockchain efforts that we're seeing today are very much focused around how can we use technology for custody, clearance, settlement, exchange frameworks, etc., which can be used to broaden access to finance and bring benefits more widely. But I think what has really changed with this most recent period and what is the challenge for regulators has been that real possibility of financial stability concerns in the context of increasingly wide use of markets. And how do you balance wide use, wide participation in the benefits with the potential consumer and investor protection risks that engenders? And we'll turn to this in a bit more detail in the panel, but I think we're seeing quite different approaches from a legal and regulatory standpoint evolving in different jurisdictions. And I think that if we look at China, we can see the idea that China is largely making blockchain development a national priority, but basing that on a sovereign monetary instrument, a CBDC, banning non-sovereign cryptocurrencies, but building a framework for the development of other blockchain-based environments. We can see the approach, one, based on law, two, on infrastructure like the CBDC, but also standards like the BSN, the Blockchain Services Network, which is a standard for blockchain development. If we look at the EU, we can see a division between different aspects: financial tokens, non-financial tokens, and money or payment tokens, and different regulatory frameworks targeting at each. We can look at Switzerland or Russia and see examples of comprehensive legislative frameworks. And if we look across the common law jurisdictions, the US, UK, Singapore, Hong Kong, often using existing frameworks, but adding new regulations for specific purposes, particularly around market integrity, around aspects of exchanges, around aspect of disclosure. And I think the need here for most jurisdictions is to make sure that there is a definition within securities frameworks that is able to catch not only traditional financial instruments, but new financial instruments. But the challenge in many ways for many regulators is to realize that when we are talking about digital assets, it's a very wide field and that things need to be treated differently depending upon their background, what they're being used for, and the user environment and the user audience. So that, I think, is a very quick tour of what, in my view, is the emerging process. And I think our challenge for 2022 is going to be for regulators balancing some of the risks of emerging very widespread use and participation from a systemic standpoint with setting standards for future development. Across the decade of the 2020s, I think we're likely to see this ongoing tension between centralization, decentralization, and the role of the state and regulators somewhere in between. Thank you all very much.
Thank you very much, Professor Arner. I think that's really sparks our thinking as well. And now I've got some questions to ask you because we have some 15 minutes for the questions and answer. Due to the fact that the decentralized finance as well as the cryptocurrency seems to be something interdisciplinary. It has to do with technology, it has to do with laws, it has to do with regulations, it has to do with monetary policies. What kind of skill set that the regulators need to possess in order to think about an appropriate framework should they have to address the issue of digital assets in each particular jurisdictions?
Yeah, this is, I think, an important challenge. And of course, the starting point from the standpoint of regulators is a realization that digitization and digital finance aren't going away, that you can't ignore it, you can't hide from it, and that the starting point is to focus on understanding. Why? Because from the standpoint of understanding what is going on, that enables you to identify both the opportunities, but also the risks, and to be able to try to, from the standpoint of one's regulatory mandates and objectives, to try to consider how to design frameworks that balance the opportunities and the reality of digitization with some of the risks and concerns that, generally speaking, I think what I've tried to highlight today is that many of our traditional financial regulatory considerations haven't gone away as a result of digitization. And we need to think about how to apply those objectives and concerns to the new world of digital finance. So it's good in that it keeps things interesting. It's a challenge in that it requires regulators constantly to be learning and looking at new technologies, because things can move so quickly that if you don't do that, you can really miss the risks while they grow.
Thank you very much. And now let's come to questions from the floor. It said many jurisdictions now adopt the Twin Peak model for financial regulation, separate between conduct regulator and prudential regulator. Do you think this model is still appropriate when it comes to crypto assets?
Thanks for that. I think when we are looking at regulatory structure, there's a need to look at the context of each individual jurisdiction. And of course, if we think about regulatory history, if we look at the 1929 crisis, we can see the advent in the United States of the sectoral regulatory system. And amongst that, the securities laws, and eventually the evolution of the Securities Exchange Commission in the United States. And because of the success in the United States of developing capital markets, similar approaches all across the world. But over time, the barriers between those different sectors of the financial system broke down. And this meant that those, if you will, sectoral regulators, instead of being able to address the risk within their system, were unable to deal with the cross-sectoral regulatory risks. And we can see from the late 1990s a trend towards perhaps a single regulator system with the UK's FSA and jurisdictions all over the world thinking about whether or not they needed to have a single regulator. I think 2008 and some of the failures that we saw with the single regulatory structure has driven a new trend toward people thinking about other systems, in particular Twin Peaks-based systems. And from my standpoint, the Twin Peaks-based system, with one regulator focusing on prudential concerns, another focusing on conduct concerns, is one that makes a great deal of sense. And I think that as we look at digital finance and digital assets, it's likewise one that makes sense. Why? because you are giving a clear objective to a regulator. One is prudential, one is conduct. The second is that the regulator is then able to develop staff and tools that focuses on its core mandate and achieving the mandate. And there's a very different approach between a sort of prudential regulator, which is often a technocratic market development support, and a conduct regulator, which is much more of a police, a watchdog, an enforcement type regulator. And so for me, I think that there is a lot to be said from the standpoint of digital assets, which blur not only cross-sectoral differences, but also blur differences between different instruments, different products, different markets.
Thank you very much, Professor Arner. Another question. FinTech is making finance faster and more technological centric. In terms of investor protection, what should the regulator do more to ensure that investors are capable of properly conduct or engage with this new provision of finance?
Yeah, I think you've just actually highlighted what is going to be one of our biggest challenges across the next decade. And, we knew before COVID that financial inclusion and the role of digital finance in financial inclusion was tremendously powerful. But we also knew that the ease of availability of finance as a result of digital communications brought with it new risks. And in particular, we had seen many aspects of this from the standpoint of consumer borrowing and credit, and the fact that people with low levels of financial literacy would perhaps overborrow, get themselves in financial trouble, and then cause not only problems for themselves, but also wider issues for the society, the economy, and the financial system. Coming out of COVID, we're looking at both financial inclusion as well as digital inclusion. And so I think we're thinking about both digital literacy generally, and particularly things around cybersecurity, but also financial literacy. And one of the biggest areas where we're seeing questions and concerns about this today is what we call the gamification of finance, and the idea of making access to finance too easy in some ways, too much fun, and the possibility that this makes it even easier to engage in some of the behaviors that we traditionally see in finance in the context of herding behavior, bubbles, market manipulation generally. And therefore, from a regulatory standpoint, I think financial inclusion with digital inclusion is going to be a big challenge. But the technology also provides new opportunities. In other words, how can we embed as part of, say, a licensing process, the requirement for developers or licensees to embed literacy training programs, investor suitability frameworks into their apps, so that at the same time that they are making it easier for people to access, they're actually enabling people to learn better about the tools and techniques that they're accessing to.
Thank you very much for your clear answer. And since you mentioned CBDC several times, there are a couple of questions concerning the CBDC as well. Should a digital currency such as the CBDC be recognized as a legal tender?
So, I think the key point here is that if we're talking about a CBDC, a central bank digital currency, is different from a cryptocurrency or a stablecoin. A central bank digital currency is digital money issued by the central bank. And as a result, there's no difference between digital money issued by the central bank and paper money issued by the central bank. And so the challenge in some ways is obviously in a single jurisdiction, it will be by its very nature legal tender. One thing that will be a challenge, however, is that the availability of central bank digital currencies may make it easier to use central bank digital currencies from other countries in other countries. And that, I think, is likely to be a major concern for countries all across the world. And in fact, I think this is one of the aspects that is driving many central banks to look at central bank digital currencies, to be able to develop their own robust, attractive domestic currencies to avoid the possibility of loss of monetary sovereignty, particularly via individual citizens choosing to use a central bank digital currency from another country.
Another question, should digital assets be highly regulated and or widely promoted as a new financial tool? It comes into balance again.
Yeah, I think the key point here is balance. We're seeing different jurisdictions take different approaches. But I think the key is to differentiate the technology and the uses of that technology, to realize that there are going to be different opportunities and different risks. And it has to be said that from the standpoint of the industry, perhaps one of the biggest risks to the industry is some sort of major fraud, market collapse, market abuse, etc., which would impact trust by the wider population in digital assets more generally. And so in the same way that we've seen with stock markets, with bond markets, with all sorts of financial instruments over history, there's actually a very important role from the standpoint of governments and regulators in making sure that the trust is there from the public, which in turn supports the wider use of the instrument to secure its benefits.
Thank you. Another question, which should be one of the last questions, as crypto assets are not necessarily security, which entity is responsible for its regulatory?
So I think the emerging consensus in fintech and digital asset regulation is that the best way forward is what one considers a sort of activities-based approach that is proportional to size, scale, and risks. In other words, that if something is a payment instrument, it should be regulated like a payment instrument. If something is a monetary instrument, it should be regulated like a monetary instrument. If something is a financial instrument, it should be regulated like a financial instrument. If something is a sort of prepaid contract of some sort, it should be regulated accordingly. And to realize that different types of uses draw with them different regulatory considerations. And the fact is that different technologies, different digital assets, different systems do different things means that they raise different considerations. And so the most appropriate regulatory body is going to be the body that is responsible for consumer protection or payments regulation or monetary regulation or financial instrument regulation or communications regulation, depending upon the activity. But if something scales and gets bigger and bigger until it becomes something like a Libra, one would probably need a larger systemic approach to the regulation of that entity outside of its individual activities.
Thank you very much for a very clear answer for that. We've got a time for another two questions. And the penultimate one, any examples on regulating digital assets to avoid illicit financing?
Well, that's one where we've seen a great deal of work from the standpoint of the G20 and the FATF in developing frameworks to address this in the context of virtual asset service providers, VASPs, the travel rule, and using that as a mechanism for achieving customer knowledge, customer due diligence, and policing participation in the market. The other area where I think we're seeing emerging developments is in the context of digital identification, sovereign digital identity frameworks, and tying those potentially to transactions. After all, if a transaction is done on a proven identity basis, that may even be a framework that is better than relying on an intermediary like a VASP for the customer due diligence process.
Thank you very much. And here's the last questions for you. Some argue that in DeFi space, the code is law. Thus, it seems that the law governing in DeFi space is determined by the code writers and the developers. Do you agree with that statement? And how could regulator embed their regulation to the code?
Yeah, so this is a question that my co-authors and I have addressed in some detail. And I think the challenge, there's a difference between systems like Bitcoin, which really is truly decentralized, and most other systems where you have a range of developers, promoters, etc. And the reality is that very few judges in the world will be willing to accept that a technological framework trumps their legal system. And that in the context of an actual insolvency action and estate action, these sorts of things, that it's quite certain that the law will trump the code. And one of the biggest challenges from the standpoint of DeFi in particular is around the questions of settlement finality and the fact that in an unwinding of transactions in an insolvency, unless one has an effective legal or regulatory framework that defines the settlement finality there, the possibility of unwinding of disaggregation is in fact always there. And so what we actually argue is not that decentralization means that you're not potentially liable anywhere. It actually means you're potentially liable everywhere. And so in any project, one of the first things you're looking at is how to ring fence that to a certain extent.
Thank you very much, Professor Arner, for your contribution today and for your clear answer. It was a really eye-opening and highly intelligent 45 minutes. Thank you very much for joining us. Thank you very much, Professor Arner. Thank you. ขอบคุณครับ
Thank you.
Well, that was a really valuable 45 minutes from Professor Douglas Arner, the Kerry Holdings Professor in Law, the University of Hong Kong. I'm pretty sure that the participants from around the world who is now joining us here in the first SEC Thailand International Digital Asset Webinar would agree with that. Well, we still have got one equally interesting program here in this afternoon, which is a panel discussion on opportunities, challenges, and barriers of digital asset businesses. But now we would like to take a couple of minutes break, and then we'll come back with that panel discussions where we will have 5 gentlemen, 5 panelists to share with us their the development of the digital asset in 5 different markets. And stay tuned, we'll be back in a couple of minutes.
Thailand will be on the road to sustainable growth when its economy strengthens and the capital market becomes solid. The capital market serves as a catalyst for economic growth by providing access to capital for investment projects, both in the public and the private sectors. The capital market is, therefore, fundamental to the country's economic success and plays a key role in the life of all citizens to ensure that the supervision and development of capital market is effective, reliable, and accessible to every sector. The Securities and Exchange Commission, or the SEC, was established on 16 May 1992 by virtue of the Securities and Exchange Act 2535BE, or 1992. The SEC has a key role in supervising all of those concerned in their relationship with the capital market. For businesses that raise capital by offering securities for sale to the public, the SEC will ensure a complete information disclosure to bring confidence for the investors' decision-making. The SEC grants licenses and supervise professionals who have the duty to assist and prepare the business of issuing securities for sale. In overseeing the stock exchange, the SEC ensures that the system for trading, payments, and delivery of securities are effective, and the securities or payments are delivered properly to the investors. The SEC also supervises the stock exchange and monitors irregularities in trading, which would lead to investors being taken advantage of, and to refer any suspicious matter to the SEC for investigation and discipline where it is appropriate. In granting securities business license, the SEC oversees the licensing process and the performance of personnel such as investment advisors or fund managers, and ensures that they provide proper service and advice and protects the investors' assets. Furthermore, one of the SEC's main roles is to develop the Thai capital market and to support the creation of financial and investment innovation, such as derivatives, trusts, and digital assets, and to serve as a center for investment knowledge for the general public. By placing an emphasis on investor protection, the SEC not only accepts complaints relating to the capital market, but also gives information and advice to the public. We are SEC Help Center at 1207, 24 hours a day, every day. At the same time, the SEC has been in close cooperation with international regulators and organizations to keep driving the Thai capital market towards sustainability on par with international standards.
Well, welcome back to the last but equally interesting sessions of the first SEC Thailand International Digital Asset Webinar, Policy Implication for Digital Asset Regulation, a Peek at Global Movements. We think that the exchange of experience of different countries and different markets in relation to this newly emerged crypto assets market will be very useful approach for all of us in order to learn what happened here and there and how can we draw some lessons from different markets. And these sessions, we are very honored to have 5 gentlemen from 5 different markets together here with us, sharing their experience concerning the digital asset market in their countries as well as in their region as well. And likewise, this session will be approximately 45 minutes, and afterwards the last 15 minutes will be kept for your questions, and that will be addressed later on in the last 15 minutes of today's session in this webinar. And I would like to invite 5 of the panelists to be here. They are already joined us online already. And the 5 panelists today here, first one is the co-chairman of Blockchain Association of Singapore, Mr. Chia Hock Lai. Hello. And second from United Kingdom, I think you are still in very early in the morning, Mr. Ian Taylor, who is Executive Director of Crypto UK. Hello, Ian.
Hello, everybody.
And the third one is the Digital Asset Investors Protection Center, Upbit in Korea. Lee Habung. Habung-shi, hello. And also here we have the partner of Baker McKenzie in Zurich, Herr Dr. Manuel Meyer.
Hello, thank you very much.
Hello. And also we have the associate from Baker and McKenzie in Zurich as well, Mr. Christopher Murrer.
Hello, happy to be here.
Hello. Well, it's great to have all of you here. And I would like to ask each and every one of you to tell us about the development of the crypto asset market in your country or in your region. And especially, I think that since majority of the participants here today are, regulators, and they have one key question, which is what should be the optimal balance between, on the one hand, promote innovation, that's mean the crypto assets, and on the other hand, how can we ensure that the investors' interest will be protected? And I would like to ask each and every one of you to share what happened in your market, starting with Mr. Shia in Singapore.
Hi. Good afternoon, good morning or good evening, wherever you are. My name is Hock Lai, co-chairman for Blockchain Association Singapore. We are a non-profit organization set up to support the growth of the blockchain and digital assets industry in Singapore. So for Singapore, we introduced regulatory certainty for cryptocurrencies since January 2021 under the Payment Services Act. When the regulator, the Monetary Authority of Singapore, took the opportunity to streamline the payment regulations. And in addition, they decided to expand that regulation to cover cryptocurrencies, which under the regulation is termed as digital payment tokens. And we have more than 170 applicants for that license since it was launched out of 400, because that Payment Services Act also cover the other kinds of digital payments. So you can see that 2 out of 5 applicants are interested in the payment services license for cryptocurrency. Even though Singapore is a very, very small market, a population size of only 5.6 million. Today, we have left with about 60 plus applicants because quite a number of them have withdrawn or declined. And they are mainly operating under an exempt basis now until their application got processed. To date, about 3 licenses has been issued so far. One to a foreign-based crypto exchange, one that is based in Australia called Independent Reserve. The other one is for a remittance player called FormoPlay, and the other one is for a local stock brokerage by DBS. So if you look at crypto transaction volume, right, cryptocurrency, the volume is actually quite insignificant. The top 3 cryptocurrencies, the transaction volume is less than 2% of that of the local stock market, the Singapore Stock Exchange. And in terms of derivatives, it's less than 1%. And then in terms of like asset under management, right, it's less than 0.1%. And all these crypto-related funds are not available to retail investors. The other part of like digital assets is what we call as asset tokenization. So I think that is a part whereby MA is more encouraging of that kind of tokens that are backed by asset. And those are the assets we normally call it securities token. And there's already an existing regulation to govern that, which is called the Securities Futures Act. And interestingly, I mean, the audience, most of you are regulators, right? In Singapore, we actually have like 2 regulatory sandbox. Close to 50% of those operating in the sandbox are actually using DLT technology. So for example, like we have a startup that tokenized corporate bonds, because corporate bonds cost about 200,000 per lot. Through tokenization, now corporate bonds are become accessible in denominations of $1,000. So we have other startups that are tokenizing other types of assets, including real estate or even precious commodity like gold. And MAS has been experimenting with blockchain technology since 2016 under Project Ubin. The experiment ended in June 2020 last year. It has been now commercialized by a joint venture of JP Morgan, DBS Bank, and Temasek, the Singapore's sovereign wealth fund. It's now called Project Carpaccio. But this is an experiment on wholesale CBDC because the MAS position is, at this point in time, the domestic digital payment infrastructure is already very efficient. There's no real need for a retail CBDC in Singapore yet. But for wholesale CBDC, it is still very much relevant. In fact, this year, MAS is collaborating with a few central banks, including with the Bank of International Settlements Innovation Hub on a new project called Project Damba, which is a project to experiment on creating a shared utility for multi-CBDC. So if you look at CBDCs, the objective is to lower down the cost of cross-border payments, just like we did that for international calls last time. But through the use of voice over IP, we are able to significantly reduce the cost of calls. So through the use of multi-CBDC, I would call it money over IP, to lower down the cost of international payments significantly, especially for retail payments. So in Singapore, you can see that actually, while there have been a couple of media saying that Singapore is a safe harbor for crypto, actually our regulations are quite stringent, and the focus is not on systemic risk because the crypto volume is not high. The focus is really on the money laundering risk and on the terrorist financing risk and on technology risk. So those are the three focus. And over the last 12 months, we see a significant increase in institutional interest in the crypto space. I think that gels very well because Singapore is already a financial center and the leading fintech hub. So I think that is a part I see that is growing rapidly now. More importantly, we are seeing that, especially over the last few months, many foreign players are now coming to Singapore to set up their business hub. While they are aware that it's very difficult to get the crypto license in Singapore, but they see that Singapore is still a very attractive place to put their R&D, their product development activities in Singapore. Thank you. So that's my very quick summary of crypto development in Singapore.
Thank you very much. It seems that the entrepreneurs work quite harmoniously with the regulator, even though you said that the regulation is pretty stringent. And once you mentioned about the crypto license, we might ask you a bit later on, I mean, how stringent is that? Are there any kind of new challenges that you and the regulators will be facing in the future? And now let's go to United Kingdom. Ian, how would you share with us the development of the crypto or digital asset market in the UK, and how do you work with the regulator in terms of regulations and so on?
Hello everybody, thank you very much for inviting me to this panel. As the previous panelists mentioned, as a trade body, it's our primary objective to ensure that policy is balanced and proportionate for what is largely an unregulated industry today, and I can talk to where the UK is in terms of what policy guidelines have been released and what's coming in the future. So I'm sure some of my colleagues here will talk about Europe and MiCA, or MiCA, Markets in Crypto Assets, which is being adjusted and written into law in probably the next year or so. The UK has taken a more, let's call it, wait and see piecemeal approach. Naturally, the first piece of regulatory clarity we've seen in the UK is protecting against money laundering, terrorism financing, which is a transposition of the EU AMLD5 prior to Brexit. We won't talk about Brexit today, that's not the topic of this discussion. However, that started in January 2020. And as with any new piece of regulation for an industry that has not really experienced regulation prior to this. There's been a few issues with this, and I'll just give you a few statistics. So when this was launched, the FCA, the UK's Financial Conduct Authority, received some 200 or so applications. This is significantly greater than the expected number of applications, and we've seen quite a lot of friction in terms of COVID not allowing case officers to visit applicants being frustrated with lack of questions coming in time and the duration it's taken. So we've now fast forwarded probably 18 months or so, and we've only had 15 companies admitted to the register, and for about a year that was only 4. We know that a whole cohort had been have withdrawn and can go away and reapply. So we know that the bar is set quite high with this piece of regulation. This is an activity piece of regulation that all financial institutions and lawyers and estate agents have to conduct. So it seems to be moving through now when we talk to the FCA regularly, naturally, as a trade body, and help them understand the issues and also help our members and the community understand what the requirements are. So that's piece number one, or pillar number one. Pillar number two in the UK is marketing and promotions of promotions of crypto assets. A consultation closed at the end of last year that will bring in any promotion of crypto asset into the financial promotions order, which will require all participants, if they want to promote their digital asset services, will have to have this checked and signed off by an authorized entity in the UK. That will come, we expect, next year. And then the third piece of regulatory clarity, and it's interesting, the industry has been asking for regulatory clarity for many years, but we always say be careful what you wish for. But we do know that the clarity breeds lack of uncertainty. And so the final piece of regulatory clarity in the UK is around stablecoins. So naturally, all jurisdictions have been looking at private stablecoins. Because of a number of developments, whether it's Facebook's DM or the growth of stablecoins used for decentralized finance, for example. What we know in the UK is that stablecoins are not being used for purchases of coffee, for example, so not systemic at this time. However, when we talk to Treasury that are writing the statutory instrument right now, it's not coming to law yet, but we expect this next year. That this is a forward-looking piece of regulation. One could assume that perhaps instead of business to consumer, B2C, stable coins could find a use in business to business, B2B. And we're already seeing that where many organizations are paying employees in stable coins, paying suppliers in stable coins. So that is obviously in the crosshairs and the focus of policymakers. And the use case for stablecoins is quite interesting because generally you would be paid in the UK, for example, monthly on a payroll. It's not practical for the old payment rails to pay somebody daily, for example, but you can imagine a world where people could be paid by the minute with stablecoins because there isn't that lack of ability because the technology provides for a greater amount of transfer of value. And then, so that's the three areas that are in play right now. And just to sort of talk quickly about token taxonomy, and this was the reason that Crypto UK came to being and was founded back in 2017 when the UK government formed its crypto asset task force to understand the different types of tokens. So the UK doesn't regulate the coin itself. Payment tokens, so Bitcoin, is out of scope. Utility tokens, such as Ethereum, is out of scope. Security tokens, as the last panelist mentioned, something that represents a real world asset, such as gold or equity, stock or share, is regulated and falls under the current regulatory regime. So that's either FSMA or MiFID in the UK. And as I mentioned, stablecoins is kind of a new category that's come into being in the last a few months. So that's where the UK is on tokens. We're focusing on the activity. There's no regulatory thrust into market participants, which is perhaps somewhat different in what's proposed in MICA. And then what we know from our discussions with the FCA is there's been a large focus on protecting against consumer harm, as you'd expect as the financial regulator. And this has been really, really advanced in the number of issues around people being taken advantage of vulnerable people and scams, whether that be social engineering or rug pulls of particular projects. UK citizens have been increasingly adopting crypto assets as a means of investment in the UK, and with that has come these whole host of additional issues that have faced the regulator. So we're working closely with the FCA to help understand what can be done, number one, to help them protect against this, and also help the traditional financial institutions take more comfort with crypto, because there is quite a high bar in risk tolerance for financial institutions to, one, offer services to crypto businesses, and two, even we've seen blocks of transactions to crypto exchanges from some of the main high street banks in the UK for this reason, because they do not want to be holding the bag if it is a scam. And we have seen a big increase, as I mentioned before. And so the UK, as most folks know, is a financial centre, has great access to resource in terms of fintech, is a fintech leader. So we have a really good opportunity to really develop our ecosystem, and we are seeing that. We are seeing projects build here in the UK, whether that's within the FCA sandbox or outside of that. We have a great community at Crypto UK, nearly 100 members, and what we do see coming in the future for regulation is probably areas protecting against market integrity and market surveillance. And I think that is also the case for other policymakers, also mentioned in Singapore as well. We do know that there is also a focus on perhaps some market participants, whether it be VASPs, but we see with the recent FATF guidance, which was updated just last week. And interestingly, we were very pleased, as we advocated for that guidance to be somewhat dumbed down when it comes to bringing into scope decentralized projects. And I'm sure we can talk more about that exciting space later in this panel. Thank you.
Thank you very much, Ian. Since you mentioned several times about the clarity, in the next round, should the times allow, I wish to discuss with you which particular kind of clarity that you might need, and how do you work with the regulators, because it seems that the market seems to be quite vibrant and very dynamic as well. And from the UK, let's move to Korea.
Hello.
Sawadee. Well, can I ask you to describe, the overview of the development of the crypto asset market in South Korea?
Okay, I wanted to introduce in brief. Korea's situation is similar, but a little bit behind, I think. Korea government is very negative on crypto exchanges, cryptocurrencies. Act on reporting and using specified financial transaction information has amended and adopted better binding recommendations, and the 2019 guidance for risk-based approach to virtual asset and virtual asset service providers. The newly amended Act defines virtual asset service providers and requires the existing major virtual asset service providers to register to notify with the Korea Intelligence Unit for the proposal of AML safety compliance, such as CDD, EDD, STR, and travel rules, etc. It also requires virtual asset trading platforms and its users to have verified real and bank account to provide and use virtual asset exchange services. Virtual asset exchanges are required to submit the certification of so-called ISMS, Information Security Management System. As of September 25th, 42 existing virtual asset service providers have applied for the registration. Among them, virtual asset exchanges were 29. Among 29 exchanges, 2 exchanges passed the registration scrutiny. My company, Upbit Korea, became the first successfully registered virtual asset exchange. Now, full written crypto regulation is absent or scattershot. Like any other countries, regulating crypto industry may require majorly think of how securities regulation works. Personally, I have interpreted into Korean and provided to the stakeholders the regimes of France, the 2018 Royal Emergency Decree on Digital Asset Business of Thailand, and the Payment Services Act of 2019, and relevant notice of Singapore, and some guidelines from such as United Kingdom, FCA, guidance, etc. Thank you. In brief.
Thank you very much. We'll come back to you a bit later on about, what are new challenges in the future and how to work with the regulators in order to ensure that it comes into an optimal balance. Now let's go to Zurich together with Dr. Meyer. Of course, I would like to ask you to elaborate the same things in Switzerland, as well as how can we find the right optimal balance between regulating things in order to ensure that interests of investors are protected, but at the same time, crypto market can move as it is innovation of opportunity.
Thank you very much. So, as everybody should know now, Switzerland has this year enacted its blockchain law, the DLT Act, as we mentioned. This is a consequence of the blockchain boom of 2017, where everybody know that Switzerland, with its crypto valley in Zug, played a major role over the entire world, like Ethereum is based there, for instance. This DLT Act is important to understand the development in Switzerland, also of the market itself. First of all, a small side note, as the Swiss always are, we are neutral, so the DLT Act is neutral, technology neutral, right? So it has been drafted with the idea in mind of blockchain, but you can use it for every technology, and which fulfills certain conditions. And the big news here is, and that's very crucial to understand, the big news here is, for the first time, you can certify real rights on a blockchain, right? You can transfer real legal rights through transactions on a blockchain without signature requirement. And that was the big news. And this is what is required in order to be able to connect shares, loan rights, and so forth to a token over the blockchain. So now you can really create asset tokens in Switzerland. And this is the new, and this is also the reason, or it comes just in time, because we saw as lawyers since about 2 years an extreme exponential demand of our clients with projects to issue asset tokens, right? So we have now the instrument to do it. A second thing to think, a second big pillar that has been established with actually the blockchain law are the so-called new trading facilities, right? We have a new type of trading facility. It's the DLT trading facility. That's brand new. And what is a DLT trading facility? Well, let's put it in very basic words. Actually, it is like a stock exchange. It is a facility where you can exchange digital assets, right? So it is ruled very similarly to a traditional stock exchange. So nothing really new in that respect. The real news is here that everybody can participate, trade on a DLT trading facility. And that's the big difference to a traditional stock exchange, where typically you only can trade over such a marketplace if you are an authorized securities dealer or otherwise a supervised participant. And this was necessary to create the basis for the asset trading facilities actually in Switzerland. Obviously, still, don't misunderstand me wrong here, still the DLT trading facility itself is still subject to regulation. No, this does not change, but the access is now possible to everybody. And now this is a bit the legal framework from a marketplace standpoint. What happened? We have the two big crypto banks fully regulated that are growing and growing, right? One of them even started to launch a DLT trading facility where you can issue and list tokens, even asset tokens, right? And in a very safe environment in compliance with regulatory laws. This is a big news. And they already started to issue asset token, very interesting one, an NTF a few months ago, just NTFs representing a Picasso painting. So now you can acquire ownership, co-ownership in very famous art painting over such a marketplace. And that's brand new, right? And this allows new investment and monetizing opportunities that didn't exist beforehand. Although in this respect, I would like to just make show a bit the downside. These marketplaces very young, right? So you don't have that lot of investors around it yet. This means that fundraising investments amounts still are in 1 or 2 digit million amounts, and not in 3 or even 4 3 digit million amounts or even billion amounts. We are not there yet. And another thing we noticed this year, but actually it already started last year, is we have one very traditional bank in Switzerland. It's called Swissquote. It was the very first fully online bank. It started in 2000, actually, that has started to offer to their customers access to digital assets. So as a traditional bank customers, you get access to digital assets. And what happened with this bank? How does this translate in figures? Well, last year they doubled their profit. And this year they already announced they will double their profit again. So you see, there are huge investments amount in the game. So this is a bit an overview of what's going on. To summarize, we have a regulation. We have asset tokens are here at the moment very trendy, and marketplaces that are coming up. That's a bit the trend. And we have 3 banks, 2 really full crypto banks, and one that is offering to the greater public access to crypto assets.
It seems that legislation as well as the regulator in Switzerland was very fast. I mean, you issue the blockchain law, I mean, ahead of many jurisdictions already, and you have crypto banks already. That means you have infrastructure ready even before the dispute starts. Okay, we'll come back to you later on. I mean, how can regulators and as well as the legislation was very fast, and sometimes it seems like they are pretty ahead of time. Thank you very much, Dr. Meyer. And now let's go to another gentleman from Zurich, Christopher. I think that you can share the examples or what happened also in the European Union. I think that's a very big market. Can you share with us the development of the crypto asset in European Union?
Yeah, sure. Yeah, thank you for having us. And in Europe, I think what's really notable is that we've seen a lot of the leading fintechs. These are the most noteworthy companies in the world that grew rapidly over the past 5 to 10 years, but we're providing some cutting edge financial services in the kind of traditional realm. They began incorporating crypto products and services into their offerings. And then we also saw incumbent banks beginning to partner with some crypto native startups to expand the offerings that these incumbent banks had. And so they're basically sharing their resources and sharing their customer pools. And I think what this signals is the integration of traditional and crypto services for customers. These are no longer separate customer segments. These are services and products that will be enjoyed and are enticing to all customers across the financial services market. I have to admit I am a U.S. attorney, so I do have to venture over the ocean to do that. The U.S. has a bad reputation in terms of regulation. And some of it's justified in a way, but I guess I want to highlight that the US does harness the spirit of crypto in that regulation is decentralized. It's across many different regulators. It's not centralized in one regulator. So at least the spirit of crypto is in the US government. The downside, of course, is that all of those various regulators, the securities regulator, the commodities regulator, the tax authority, the financial crimes authority, they all claim jurisdiction over crypto. So that kind of makes it complicated and difficult to navigate, and hence the reputation. But there are a couple notable market developments. I think it's important to keep in mind because it shows that the crypto market is maturing in Europe and it's maturing in the US. So Coinbase, one of the world's most prominent digital asset exchanges, became a publicly traded company on the NASDAQ stock exchange. Its current market cap is around 85 to 88 billion. And I think for most, this was seen as a major step in establishing crypto's position in the mainstream financial world. The US SEC filings demonstrate that there was vetting and auditing of the company. There was a long-term business plan, extensive balance sheet and revenue figures. And like all of this gives substance, I think, that helps many recognize that crypto companies are serious, large-scale operations. Another, I think, major development we have to keep in mind is last December, the US SEC filed an action against Ripple Labs as a company that helps work or promote the XRP token, and also filed the action against two executives, alleging a $1.3 billion unregistered ongoing digital security offering of the token. And I think what this case shows is that regulatory actions in one country can have significant effects on token values and listing venues on a global scale while that matter is in the courts. So these are global tokens, and the issues in some countries or region can have a global impact on the entire market. So I just want to emphasize that it's really important to monitor the regulatory status of tokens in other parts of the world. And as this panel is highlighting, is we need to look at all these different regions when we're considering this market. As my colleague mentioned, the NFT market is really heating up. I think this is really exciting. And I think this is going to come together with the metaverse. Well-known names are involved already, and previously little known or unknown people are now becoming famous on a global scale. Beeple, a digital artist, teamed up with Christie's, a traditional art auction house, for a $69 million sale of an NFT of his collection of art. And he continues to produce art and sell them at a massive scale. Facebook announced that it's rebranding as Meta, and with a focus on the metaverse, which is a type of interconnected, interactive virtual world where digital assets are used. And Decentraland, a separate metaverse community, allows people to purchase plots of virtual real estate, and a plot in Decentraland sold for $1 million US. We're seeing sports leagues selling NFTs that represent collectibles and trading pieces of clips of art, pictures, stats for these athletes. And so all of this is kind of coming together and demonstrating, I think, a really cool maturation of the industry.
Thank you very much, Christopher, for having shared with us the transatlantic example, both in European Union as well as in the US. And now, imagine we still have got only 10 minutes left, but it is compulsory to me to ask you the questions about your view upon the decentralized finance from each of your market. May I start with Mr. Chia first?
Okay, I think for decentralized finance, the regulatory standard is still in the flux. I believe that's the same in everywhere else. Perhaps the clearest reference will be from the latest FATF guidance just released over last week. Because current, most of the regulations are on the basis that there is a financial intermediary to be accountable for all the activities. But when we are talking about DeFi, there is no such financial intermediary, because that role played by that intermediary, which is a trust role, has been digitalized into codes. However, in the FATF guidance, right, they gave the guidance that whoever maintains significant control or influence over a DeFi arrangement should be regulated for AML purpose. So that would mean that DeFi developers who are able to, let's say, restrict any coin listings, they could be regulated as a virtual asset service provider, or any party who is operating a domain that enable a user to access, they could be regulated also, or someone who can intervene in the activities of a DeFi marketplace in a significant way. So I think that probably give the guidance how to regulate DeFi. But I think that means that we could potentially seeing the market split into two parts. One is that DeFi protocol that is very much decentralized, just like how Bitcoin and Ethereum, which are very much decentralized now, they might not fall under the latest guidance, or there could be a development of regulated DeFi whereby some institutions come in to play the role, operate that user interface front end to control access, to do KYC, to do AML controls. They could be then regulated. So I think that currently that's the situation. Thanks.
Thank you very much. And now the same question to Mr. Taylor. Ian, how do you think about the DeFi in the UK?
Yeah, it's a difficult one, isn't it? The UK generally, historically, has followed the guidance out of the intergovernmental departments. So some of fellow panelists just talked about the Financial Action Task Force recent guidance, which we were pleased to see. And as I mentioned earlier, we had advocated for a rollback in the language because it was quite broad in its definition, similar to the language out of the infrastructure bill in the US for what defines a market participant. And it's quite difficult for a number of players to adhere to this, especially certain participants such as miners or fully decentralized protocols. And what even is the definition? And it's a wide spectrum. But I'll just to sort of touch upon the language that was changed to control. And that's quite fundamental because we've talked about this a lot in the custody of digital assets. When do you have control over the assets or the keys of the underlying? That's still a big debate that is raging. And the definition of a VAS that was shoehorning in decentralized protocols and even peer-to-peer transactions for non-hosted wallets. The language was somewhat too broad previously, but has been updated to not to block transactions from a centralized exchange or decentralized exchange if not compliant, which we advocated for. And there's lots of question marks for policymakers because the whole world of DeFi and NFTs, the platforms, the marketplaces have no onboarding. They don't do any customer due diligence at this time. So that naturally is a concern when it comes to economic crime and illicit finance. However, we have seen some developments on some other layer one solutions. I know some projects on the Polkadot blockchain that actually are embedding KYC into their onboarding process. There are some protocols that are offering in DeFi, offering institutional products and services. So naturally, institutions will need to have a higher bar when it comes to compliant liquidity. So source of funds and personal information will be collected in those offerings. So the work is being done. And I'm an active user of DeFi, and it has traditionally been clunky. Things are improving. There are high barriers to entry if you're not, experienced and have a non-hosted wallet, for example, and know how to operate some of these applications. And the first applications of sort of decentralized autonomous organizations has been finance and trading. But that doesn't mean we can't see other applications. We've seen that with digital art, with the NFT development, but also around perhaps social media platforms could be completely decentralized, and we could see a better world where perhaps some of the hate speech that we've seen in the last year could be better managed if it's managed by a community in a trustless way. What we are advocating for, working with DeFi entities, is to provide better clarity to the users, because right now we could improve as an industry on risk warnings, for example, on websites of decentralized exchanges or lending protocols. Better code audits of smart contracts could be improved. Transparent fee pricing could be improved, and the whole development around new corporate governance, where is it fully decentralized? Does the community run the protocol? Is there a level of decentralization? It's going to be interesting to see how these discussions play out. And yeah, I think it's a very, very interesting space that is here to stay.
Thank you very much for your contribution. Mr. Lee, how about the decentralized finance in Korea?
Actually, it's very, very active in Korea. But I wanted to mention on the decentralized finance. It's like nothing regulators have seen before. It's running faster and jumping higher than ever before. There are unique features to the DeFi. The reality of DeFi is decentralization. Technologically, it removes intermediaries like banks and exchanges from asset trading, but it could offer more benefits to the way we run mainstream asset markets. Users can contribute to a liquidity pool and earn fees and yield through DeFi protocols. The DeFi protocol can exist without a formal leadership or middleman to deputize, so regulators normally cannot interact with any operating legal entity and will have to rethink approaches to the enforcement. DeFi developers write the software that automates transactions and say they then step away from the project, allowing it to operate with no central entity in charge. They argue that such a decentralization defeats the need for oversight by the regulators. This is a particular challenge for Korean regulators, and I think it's a common issues worldwide. DeFi and crypto still aren't large enough in Korea to trigger broader financial contagion in the event of major market collapse or system failure. But as a medium of DeFi, over-issuance of stable coins might trigger systemic issues. DeFi would make the fundamental advantages to the technology accessible to many more participants, particularly public companies and regulated institutions. But now the Korean government didn't allow the regulated financial institutions to participate in the DeFi. In the long term, the regulatory clarity will give a crypto firm or a platform for growth, including DeFi operators, while maintaining the key advantages of DeFi for institutions, including self-custody, decentralized liquidity provision, and transparency. Personally, I think the DeFi gets regulated and eats away at more traditional trading technologies. A small group of protocols that are truly decentralized will continue operating outside of regulations. This may be the common phenomenon worldwide. The Korean government now is starting the DeFi and non-fungible tokens or metaverse, etc. Thank you.
For your contribution. And now, come to Dr. Mayer once more, talking about the decentralized finance from a person who is from the country with one of the strongest financial systems in the world. Dr. Mayer, how Switzerland deal with that decentralized finance?
Well, actually, given that we have now enacted the DLT Act pretty good, right? We are not in a bad position. Obviously, the laws in Switzerland are very young and new, and everybody has to get a bit experience with it and how to translate it then in the daily life, obviously. But the rules are already very transparent and clear, and to a vast extent predictable. There is, in certain minor points, still room for improvement, obviously, but this is a lawyer speaking. So where we see a bit an issue, frankly speaking, is that all these DeFi is usually immediately international. It's very hard to keep DeFi in one country, right? One bank did it. Actually, the bank is active in 2 countries, Switzerland and in Singapore. And they did it by simply closing the access or restricting the access to their market to their own customers. So that's the way they can deal it. But usually DeFi becomes international very quickly. So even Switzerland is depending on other regulators. And there we experience exactly certain cases like you mentioned, Mr. Taylor. We are launching now, just right now, we are launching a brand new non-custodian wallet, right? and this non-custodian wallet does not fall within the Swiss regulation because our client provides as sole service a mobile app that you can download on your iPhone and then buy and sell over this mobile app Bitcoins. And our client will not interact in any of these transactions between your wallet and the blockchain. So this is really out of the control, out of the code, or out of the server of our client. However, our client provides a private key that is encrypted as a backup solution. And this is now an issue, because you will find certain countries, like for instance South Korea or other, where the mere fact that you have a backup option could be considered actually as having a custodian wallet which is fully subject to legislation and regulation. This as a short example. So even purely Swiss projects become international very quickly, and we have to deal very quickly with all the vast majority of the regulations that we find there, and this is sometimes a bit bringing us to upset. It's a bit upset, so to say, because it is time consuming and it is hindering actually the innovation in this field. And please do not misunderstand me. I personally really think that regulation does not interfere to this new business segment. I even think that the regulator should take ownership of this field more actively. And I also think that they should make clear, predictable rules, and they do not have to reinvent the world. I do not think that that digital assets do have to be regulated differently from other assets, basically. They should be regulated the same, right? So a security should be regulated like securities are, a painting like paintings are to a vast majority. But the regulator should consider certain specificities of the technology. Let's take stacking, for instance, right? If a platform collects coins merely for stacking purposes and then automatically uses the coins for stacking and then redistributes the stacking proceeds to the initial owners of the coins, this is made fully automatically. Nobody can interfere, right? It's not possible to interfere here. Again, there is no exchange of money against coins. It's within the same ecosystem. The mere stacking function is necessary for a blockchain to run. In certain jurisdictions, however, such platform collecting coins will be subject to full authorization and even also to AML obligation, which by the way, is hardly possible to do in practice because the technology does not allow to do it. So these are two things. So predictability would be nice on an international level, and clarity.
Thank you very much. Clarity come here into place once again. Thank you very much for your clear answer. And Chris, how about in the US as well as in the European unions? How do they deal with the decentralized finance?
Right, and so I think to kind of build off of the points that all of my other panelists have mentioned, these kind of apply to the EU and the US generally. I think regulators should see DeFi as an opportunity rather than a challenge, right? So we're used to a system built on intermediaries. What can regulators do, or what opportunities exist if we're dealing with a disintermediated system? So many governments require financial intermediaries to file currency transaction reports for transactions over a certain value. Does that make sense if parties are involved in a disintermediated system like DeFi? Is that even possible to require some party to file these reports? But maybe it makes more sense, or it's an opportunity for the regulator to watch the transactions on the public ledger themselves, rather than rely on parties providing an unreliable, perhaps, report when a transaction goes over a certain value. Perhaps the regulators can operate a node on the public ledger. They can monitor these transactions, and they can see this as a way of gathering information in a new way that they previously didn't have access to. And maybe this is going to be a more reliable system for them, where they don't have to rely on intermediaries to provide this information. And so I think when we're dealing with this, the regulators then should really kind of focus on protecting the people who are involved in the system. And I really think that comes down to information symmetry. So that's key, and regulators focus on endeavoring to limit the risk that one party has a deficient understanding or less information relative to the other party. Typically, we relied on intermediaries to kind of serve this function, but if people are interacting directly, perhaps this is the true focus now for DeFi. And so just for example, if parties are entering into a loan transaction directly, I think what's important is that both parties have equal access to the information about the loan's terms, they know their risks, and knowing all of that, they are still willing to enter into that agreement. And so I think the key thing here is that regulators should see DeFi as an opportunity that they should focus on, and then still maintain that core principle of protecting investors.
Thank you very much. We a little bit overspent the time, but we still got approximately 10 minutes for questions from the floor, which are many of them. I would like to select some of them. I think this is a question for Dr. Meyer. When talking about crypto bank, is that referred to crypto custodian activities?
Thank you very much. So when I mention crypto bank, I have two banks in mind. These are fully regulated banks that dedicated themselves to the entire crypto world. So these banks will not only provide access to cryptocurrencies, to cryptocurrency bank accounts, to cryptocurrency payments, they also want to advise on the issuance of asset-backed tokens, on NTFs too. So actually, these banks focus on the entire variety of the DeFi industry.
Okay, thank you for your answer. And here should be the question for Christopher. Are digital assets recognized digital securities in the US?
So they are, from the viewpoint of the securities regulator. In fact, I think what we recommend is you just assume that all tokens are securities, unless it's proven otherwise. And that's a high standard to overcome from a very prudent approach. And I think that's really because the SEC feels that they've been very clear that the Howey test applies, which is very broad. And I think as Commissioner Peirce mentioned yesterday, it seems to sweep in most tokens under its regime. But there have been some cases where the SEC has been willing to recognize that tokens within narrow parameters are likely not securities, or after an evolution of time, they become sufficiently decentralized such that they fall outside the securities regime. So again, the idea is to just start with that baseline assumption that the securities regime applies to the token, and then try to work from there, from that assumption, to see if it can somehow fall outside of it, perhaps in time.
Thank you, Christopher. And I don't know which of you mentioned the word BIS, Bank for International Settlements. I don't know which of you. Probably Mr. Chia, I guess. Okay, here's the question. Since you mentioned BIS, what's your take on that proposal to require commercial banks to reserve capitals dollar to dollar in case they invest in crypto assets? Do you think the proposal actually addresses risks associated with crypto assets? Moreover, how do you propose banks mitigate settlement risks, in particular since reconciliation and settlement cycle of crypto are in a matter of seconds, while their traditional reconciliation cycle for fiat is on a daily basis? How do you suggest we address this issue?
Okay, to be frank, I'm not familiar with that topic, so I can't answer that, unfortunately. Perhaps the other panelists have a view on that.
Any volunteer?
Yeah, I'm not familiar with that.
If not, we take it in and we try to find out the answer together in the future. And here
sorry to interrupt. The United States OCC, Office of OCC, issues some guidance on the custody and the control of ownership, etc. And the United States SEC issues new guidance about on the securities token, securities asset token custody. That guidelines describes the deposit and the daily control comparison with the outstanding stable coins and the relevant corresponding deposits. That is the role of banks, such as crypto banks or commercial banks. This is the right answer or not?
Thank you for your contribution, Mr. Lee. Thank you for that. And here's another question. Would decentralization of digital assets cause a money laundering and illegal activities? Any one of you would like to volunteer in that?
I'm happy to have a stab initially. Well, naturally, anything can be used to launder money. However, what we got to remember is within DeFi, I looked at the numbers earlier in the week, and the total value locked in or assets under management is approximately 100 billion. Now, that is a significant number for an industry that's only really been around for 18 months or so. But it's tiny compared to other markets, traditional securities markets. And it's a bit of a misnomer that, in our experience, when we talk to policymakers, that Bitcoin, for example, is the choice of criminals when it comes to, for example, ransomware. Now, this is just not true. And this is part of our community's mission to really try and change this narrative. We know this is not true because we have public blockchains where the information is available to all. There's a number of analytics companies out there that are working with law enforcement agencies to really shine a light on where the criminal activity takes place on blockchain, i.e. within crypto. It's probably, I know the Department of Justice in the US and the City of London Police in the UK want criminals to use crypto assets because it's much easier for them to track them. Naturally, the underlying wallet addresses are pseudo-anonymous. There is no name attached to that, but there's tools that we've seen used when there's been hacks, Polychain hack, for example, and Colonial Pipeline ransomware, where the monies have been returned due to actions by law enforcement and due to market participants quickly acting to blacklist wallets or to even blacklist the tokens when it be a stable token that's been used in the hacks. So I would against caution. This is what we say to Financial Action Task Force in their private sector sessions. This is we have a great opportunity here to really use this technology as a better tool to identify transactions and financial crime.
Thank you very much. We can use the technology as a tool to prevent that. Thank you very much. I wish we have much longer time, but unfortunately the time is up. And therefore I have to say thank you to 5 of the gentlemen here who have contributing really a lot for us. Thank you very much, all of the gentlemen. Thank you very much. ขอบคุณครับ Well, thank you very much. That is the co-chairman of Blockchain Association of Singapore, Mr. Chia Hoklai, the Executive Director of Crypto UK, Mr. Ian Taylor, and the Head of Digital Asset Investors Protection Center, Upbit Korea, Mr. Habung Lee, and partner Baker McKenzie in Zurich, Dr. Manuel Meyer, and also Associate Baker McKenzie in Zurich, Mr. Christopher Murrer. Thank you once more. Thank you very much for joining us. Have a nice day. Thank you very much.
Okay, bye.
Thank you. Goodbye.
Thank you. Bye-bye. Bye-bye. Auf Wiedersehen. And that's wrap up everything which is the discussed in the first SEC Thailand International Digital Asset Webinar, Policy Implication for Digital Asset Regulation, a Peek at Global Movements. And thank you very much all of us for having joined us yesterday as well as the 2 sessions today. We really hope that you find all of these sessions useful. And should there be any suggestion from your side, please do not hesitate to send to our administrator, because we try to make the second edition even better to ensure that this will be an international platform which is useful for all of you. And now on behalf of the SEC Thailand, Security and Exchange Commission of Thailand, I would like to say thank you once more, and I hope to see you next year. Thank you very much and goodbye. สวัสดีครับ